2017 saw UK dividends grow at the fastest pace in half a decade, thanks to a pickup in commodities and currency tailwinds. That's according to Link Asset Services' UK Dividend Monitor. But can payouts continue to grow in 2018? Joining me now to discuss the outlook for FTSE dividends is Eric Moore, Fund Manager at Miton Income Fund. Eric, thanks so much for joining us. So I guess the first question really is, does it continue this year, this growth in dividends that we've been seeing?
I think this year won't be too bad for dividend growth. We've seen some sectors of the market that have that cut, I suppose, or reduced their dividends over the last few years are now coming back in quite a big way. So as you mentioned there, the resource sectors, so in the recent results season we saw Rio Tinto. They've just paid their largest dividend in their entire history, and it's a very old company, so that's really saying something. And the dividend was up something like 70% on the year before.
Wow.
And they're not alone. I mean, I guess you're also seeing Glencore increase their dividend by 50%. And the oil companies, although they're not seeing much dividend growth, as the oil price has risen, you can be a bit more confident that you're going to get the dividend that they delivered last year. And similarly from the bank sector, it's another, obviously a big part of the market, and following from the credit crunch, they all cut their dividends, but we're now seeing their dividends come back as well. So those two big sectors, big parts of the market, if they can really chip in some decent dividend growth, then that will help the overall market aggregate. So
you mentioned the banking sector there. Does that really change your job in a way? Because traditionally income investing has been kind of a very secure, stable way of investing, but now you're having to look to more cyclical sectors. Yeah. How does that change your investment decisions? I think
that's a really interesting point. I think it used to be quite easy to be the income fund guy. You could own relatively secure companies like consumer staples, beverages companies, tobacco, utility companies, property companies maybe, which all had good dividends, low volatility, and really you didn't have too much to worry about. For various reasons, those companies aren't really offering the same level of secure yield and good dividend growth that you really want to see. And you do have to now start hunting in areas that maybe the traditional income funds have been a bit more shy of, such as resources. Mining companies are not a traditional income hunting ground, and indeed banks. So I think that's exactly right, and it's quite interesting to see where some funds don't look like they're prepared to really make that leap, and are saying, well, we're still sticking with the same sorts of stocks we always used to own because these are the things we understand, and this is where we think the long-term answer is. And then there's some funds of which I'm probably one where I'm prepared to sort of go where the income is a bit more. Yeah.
So you mentioned some of those bond proxy sectors, the likes of utilities, real estate, that are traditional income players. I wanted to ask you about the moves in the bond market. We've been seeing the yield on the Treasury inch up to that 3% handle. That obviously making them more competition between assets. How does that impact what you're doing?
Yeah, I think that's another excellent question, and I think that's the big question for all assets. Really is, to what extent are we seeing a change of monetary regime from emergency low interest rates and quantitative easing, electronic money printing, to something else, to something sort of more normal, if you like. And I think that moving to something more normal is actually a positive because it means we no longer need special measures. We're out of the emergency room. This is because economic growth is okay, and maybe there's a little bit more inflation. So in a way, it's a good thing. Does it mean though that the sorts of there's two questions really. Is it bad for equities per se? Yeah. And I think not, because the yield on equity market is still actually so much higher than on bonds, and historically over the long run that didn't used to be the case. So I think bond yields can rise still a bit more before you need to worry about the equity market in aggregate. But what it does mean is it means it probably has consequences for the sorts of equities you want to own. So those areas that have benefited during this sort of lower for longer period of interest rates, like staples, are probably going to be not the things that are going to do so well in a changing monetary regime as we see front-end interest rates rise a bit more and bond yields continue to edge up.
I also wanted to ask you about the insurance sector, because there's some pieces in the news at the moment saying that perhaps this sector is underestimated from an income investment perspective. We saw L&G's results out this morning. One of the standout points was the fact that its dividend increased by 7%. Yeah. What's your view towards that sector?
Well, Legal & General is one of my favourite stocks, actually. Funny you should mention that. So I was very pleased to see the results today. And for me, so I think what really drives total return in the long run is a good yield and growth in dividends. And there isn't really much else. It is as simple as that. In the long run, that's kind of all you really need. Those are the building blocks of return. And Legal & General, with a 6% yield, growing their dividend at 7%, will give you both of those. So I think it's really great from an equity income point of view. And I've owned it for a long time, and it's actually one of the largest overweights in the fund. But I think also there's other great stocks in the sector. Prudential is not the biggest yield. It doesn't yield as much as Legal & General, but again, their dividend growth prospects are excellent. And the fund also has a holding in St James's Place. Slightly different business model, but again, the income characteristics are very strong.
So are those your top picks in the top picks out there at the moment?
Within insurance, certainly, yeah. So Legal & General is definitely one of the biggest holdings in the fund.
What about aside from insurance?
So I like resources. So Rio Tinto, the fund owns even Anglo-American. Insurance is quite a big sector for the fund. We've still got quite a large weight in pharmaceuticals. And that's quite interesting. Is it one of those sectors that maybe suffers a little bit in this change in monetary regime because they traditionally sort of associated with, you know, benefiting from lower rates? But I still think there's quite a lot of innovation coming through in pharmaceuticals that perhaps isn't reflected in the share prices.
And looking at equities overall, it feels like the markets are a bit jittery at the moment after that sell-off we saw following from non-farm payrolls in last month. What's your outlook on the equity market? Are you constructive still?
Yeah, we're still reasonably positive. I mean, there's a lot of nervousness at the moment, I suppose, because the markets have had a very long and steady upward move without any significant pullbacks. And this is the first pullback we've had in quite a while. And I suppose people are rightly worrying whether this is the beginning of the big one. My view is we're still probably in our uptrends. If you look just particularly at the UK, which is, you know, my main area of interest, I still feel that there's quite a lot of support on the FTSE around 7,000 or 7,100, and we're not that far from that. So I still think the equity market is reasonably well supported here, backed up by the income characteristics. So the market overall yields 3.7, and as I said, I think there's reasonable prospects for dividend growth in aggregate this year.
Now, it seems as though in the market we've been seeing a lot of share buybacks recently. Obviously, it's very much a peak cycle phenomenon. And how does that impact dividends? Because surely if people are paying more in terms of share buybacks, that's going to mean less dividends.
Yeah, so you won't be surprised to hear I'm not a massive fan of share buybacks. So I'd rather if companies have surplus cash to hand it over in the form of dividends. And I think they also get a company will get better rewarded through their share price if they pay a better dividend rather than in the share buyback. The share buyback is just a vehicle really to let sellers sell their stock, whereas a dividend, maybe if you can increase your dividend, the benefit of that will get reflected in a higher valuation for your shares. But a dividend commitment is forever, in theory, whereas a buyback is a one-off. So sometimes managements like buybacks more because it's easier to change your mind. It's harder for managements to offer you a good dividend and then cut it next year.
I see. Eric, thank you so much for joining us. That was Eric Moore, Fund Manager at Miton Income Fund. Thanks so much for joining us on IGTV. I'm Victoria Scholar, and we'll see you soon.